Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Oh, g'day. Thanks for joining us on the Smart Property Investment Show. Pleasure to have you on the airwaves, wherever you're listening to this. And I have no idea where, but I know people tune into this, whether they're driving the car, mowing the lawns, doing the dishes. One of the great things about podcasts is that you can listen to them whenever you want. And normally it's me time, so you can go and be selfish and tune into some podcasts. And I think today in the studio we have some people who, particularly one who falls in that bracket around as a podcast addict, and I've just been told that I probably need to do a few more of these because I'm not fulfilling the requirements of this person's massive appetite in podcasting. And in the studio today I have Jeanette and Max Schudeboom. Did I get that right?
You did.
Sort of.
Sort of?
It's good enough.
It's good enough?
Schudeboom. Yeah.
It's Dutch name, is it?
Yep.
Okay. You second generation Dutch, fourth generation Dutch, third generation
He's
Dutch?
first.
I've been first. I was born in Holland.
Okay.
And then came to Australia in 84.
It's probably the best English accent, the Dutch, because it's really hard to call sometimes. It can be very neutral. I would have thought that you're born and bred here rather than 84, was it?
Yeah.
Yeah.
I decided in 84 that I tried in Dutch for a little while, and Dutch and English, and then I said, nah.
Gone.
Doesn't work.
Okay.
I started to go to work and I started to talk Dutch. And, this doesn't work.
So, Jeanette, Max, we're going to talk about property today and your journey as property investors. And because you have the same last name, I'm going to assume that you've been married for a period of time. Yep. How did you end up here? Like, it's a long way from Holland to Sydney. What's the story?
To come here, and I followed somebody and came to Australia and stayed here.
What sort of work do you do?
I was an electronic engineer.
Okay.
And I've worked for the same company since I came here, 34 years now.
That's cool.
As a electronic engineer, and then higher up, and ended up as CEO now.
Okay.
So,
that's good.
Yeah.
I imagine it pays a nice salary then to invest in property. So
yeah. Yeah.
How about you, Jeanette? What do you do for a living?
I'm in aged care now.
Okay.
I was stay-at-home mum. We've got 2 kids, so they're now growing up, 21 and 24.
Okay.
So, and I've sort of worked off and on over the years, part-time, fitting in with school hours, and he's travelling and whatever. So
there you go. And
now I work 2-3 days a week in aged care.
Cool. You guys are property investors.
We are.
You are. Do you identify being property investors? Is that is it part of your DNA? It's important.
It started sort of in, I bought a house and paid it off, and I'm one of those that said, okay, you buy it, you pay it off, and then sold it and bought another one and paid that off too. And then we said, we've got to do more than that, and did a bit of good work. We actually bought a commercial property, had that for a while, sold that, then bought some land.
Yeah, down at Point Cook
in
Melbourne.
Melbourne, and build on it, and was a bit upset with the bank at the time, and so I said we were going to keep it, but I just said no, forget it. I want to get rid of this loan, so I sold it.
The process you just spoke about there about which is a very traditional mindset to buy a place, pay it off, live in it forever, or sell it and do it again. That's a very much sort of historic Aussie way of viewing the world. What's the mindset like in Netherlands, right? Is it
in Holland? Most people don't pay off their houses actually, because most of them tax structure is totally different. It's the other way around. So instead of when you're investing that you can deduct all your expenses, in Holland it is your own home. All the interest that you pay in your own home you can deduct. So it's the other way around. So your own home you can deduct all.
So you can deduct the interest components of a principal place of residence in Holland.
But
not on the investment.
Not on the investment side. Okay. All right.
So most people just keep on. They are changing that at the moment because they're trying to. People need to pay off their houses, and But for a long time it was just people just paid the bank and paid the interest and then deducted it from their income.
Is there a big sort of rental
There is, but most of it is done by co-ops or corporations, and they build whole towns, half a town, and then rent them out. We've tried it. I mean, we got my parents' property in Holland still, tried to rent that out, and that didn't work. It's just not done the way it is over here. So at the moment, one of the nephews, I think, is in it. So,
did you, when you arrived in Australia? It's obviously some time ago now, but did you sort of think, oh, it's a bit strange how it works over here in terms of property, or you just sort of went, hang on a second, this sounds all right?
I basically decided, I came with basically nothing and was living in a unit for a little while, and then there was the capital gains tax 85 or so. Or there was something happened. I said, we need to buy something. So I went and bought a house. And I've always been, the loans, $70,000 or something alone, and I thought, wow, that's a lot. Need to get rid of that. Now you look at it and think, was little actually.
That's cool. So let's have a chat of this journey of property investment. But before we sort of look at how you've gone about building your portfolio, how big is your portfolio, by the way? Like, how many properties are within it? We'll get to it, but
13 and a half.
13 and a half.
Granny flat.
Granny flat.
We built a granny flat on one property.
That's cool.
So that's the half.
Well, it's another bit of income, right? It's,
and plus our own home that we live in.
Yeah. And when did you start investing?
Well, like we said, we bought the Castle Hill one in 2003.
Yeah.
2003. Okay.
And sort of didn't know what we were doing. And
So it's about 15 years then.
Yeah, and we've always
journey.
been interested, and
that's cool.
But didn't quite know what was what, and always afraid to do more. And then we finally got educated, and then since 2012, we've really
given it a good.
Yeah.
You said your kids are early 20s.
Yeah.
Is that right? Do they sort of got an understanding of what you guys are doing in your property investment space? Are they taking any interest at all, or they're just
no,
not really.
They probably will do later on.
They do,
and they don't. It's just.
Yeah.
Just the way it is. Which is cool, They
do know that they're not going to get it. So,
so this is. I was going to ask you this question, so I might as well go down that path now. So, why are you guys doing this? Obviously,
so we can retire on our own terms. We don't want to be beholden to the government and having to rely on a pension. Cool. My mum and dad were always very much, you've got to have the pension, and they had a little bit of money, not a lot, but it was always had to be invested to the minimalist amount so that they could always get that full pension, and I'm like, why?
You don't get it. My mum's on a pension, you get nothing.
Yeah, I know.
You couldn't. I don't know how she lives on. To be honest
so
with you,
we want to be able to just stop work when
you choose to.
Sometimes in the next 7 years or so,
6 or 7 years,
and do what we want, and live within. We're not going to be multi-millionaires, but we'll be able to be comfortable, do what we want.
Yeah, that's cool.
Yeah,
and this sort of idyllic this picture of how you see your retirement being, whether that's full-time retirement or you dabble a little bit or do whatever you do. Have you framed that on how much money you need to be able to live the lifestyle that you want to live? Is that how you've sort of gone about framing what you need to do as property investors?
I don't think we did that in the first place.
Not in the no.
In the first place, we started to just invest. And yes, we did do the course with Margaret.
Did you do Margaret Lomas's course, did you?
Yeah.
Okay, it's a good course.
And we started to learn about it, and we started to buy. And yes, we had an idea that we need to have so much to reach a target. But we never really sat down and sort of planned on, okay, how much do we need, how much, we just said, okay, well, let's go and buy and see how far we can get.
Yeah.
And
that's what we did.
And I guess we always thought too, we would perhaps sell one or two that had perhaps grown, had good capital growth, and that would then pay off the loans of the others. That was our initial idea. And then, now we're sort of realising we can probably keep everything, and with a bit of luck,
that's right.
maybe.
With a bit of luck, we also went to Ben Kingsley.
Okay.
And he did the whole...
Did
modelling.
Plan for you, did he?
He did the whole 40-year plan.
Modelling how we're going to get out of it.
Oh, no, Ben's from Empower Wealth, and he's a very thorough...
very thorough.
Stuff. How was that
You've got
journey?
to count for every cent.
Yeah. How did you find that? Did you find that a stressful process, or was it a?
He loved it.
I got everything on all our properties, all our expenses, all our stuff is on Quicken. So I have all that information. Whatever he wanted, I could just look it up and say, this is what we spent.
Max thought it was great because there was always a miscellaneous account, which was what my spending was.
Yeah.
Now we had to then say where it all went.
Ben said, "Hey, you got to know where it goes." I said, "Well, it's miscellaneous, Jeanette."
Well, I know Ben listens to the podcast sometimes, so hopefully you tune into this one. But what was it about that process that you found most valuable, going through sort of a true planning and understanding about your portfolio and what it's doing and how it's doing it and why you're doing it?
Well, it sort of showed us basically that, I can't stop probably in 5 years. I probably could if we were going to sell any. So he sort of worked out, okay, it needs to be about 7 years, and then you can, you go through a dip and you cash flow because you lose out the money that you make. and then worked out, okay, you will bottom out, but you will still be in the positive. So, if you stop at 7 years and you wanted, what did we want? I don't know, 100,000 or so it was, the figure that we picked at the time. And, you could just see that you could actually survive the time that you didn't have your superannuation excess and all that sort of stuff, to the point where you start getting access to that, and then starting to pay off some of the loans and see that you actually could survive by keeping it all. Which I didn't really. I mean, I was always thinking, we buy these, and then the ones that are growing, we'll sell them and pay off when I'm retired, so that I don't pay too much tax, capital gains tax, and then pay off some of the ones that that we can keep to pay our retirement, our lifestyle.
What did he think of the portfolio, the mix of properties that you had? Did he think they were by and large okay, or was there?
Yeah, he didn't like our Elizabeth East properties. We've got two there, but they're good money earners. I mean, they were the first two we actually ever we bought after we did Destiny, and they've been very good with their cash flow. That's
reasonably good. I mean, there's a few costs in there too. That,
we'll run through the portfolio in a sec. So you've got your computer there, and I imagine you've got it all listed out there. It sounds as though there's no shortage of information that we can drill into. But
it's one of those spreadsheets that you talk about.
You should see my spreadsheets. It's an absolute headache. But Max, you're a fan of podcasts, so education is obviously important to you, and you've spoken about Margaret Lomas's course, which from all accounts is very thorough. Ben Kingsley and the work that he's done with you. How else have you gone about educating yourselves? Is there anything else, any tips that you would have to any of our listeners over a 15-year period of investment? Where's the best bits of information to understand what you need to do?
Be wary of the spruikers.
Did you ever run in with any of them at all?
The first one was probably, it wasn't the spruiker one. The first one that we did was really, we bought it through
Defence Housing.
DHA.
Okay. Yeah. I'm not going to say Defence Housing spruikers.
No. But
we realise now, in hindsight, how much we've paid in fees, and we didn't earn as much rental, did we, as what we
the management fees are high. You paid full price, definitely. On the other side, they always paid rent, whether it was empty or not. That doesn't matter.
It's a particular proposition. DHA,
and it ended up being a good one because it's in Castle Hill. That's finally, it took for years to take off, but it's finally.
Castle Hill's great.
Yeah, now it is.
What sort of property is it?
4-bedroom townhouse.
Okay.
Gated community.
You're not going to do too badly on that. Castle Hill rocketed over the last
not now, but for a long time we carried it.
Yeah, I betcha. So that was your first property, Castle Hill. So let's go through the portfolio. So Castle Hill.
Yep.
So what else do you have?
Then we bought 2 in Elizabeth East.
In Adelaide.
Okay. What did you pay for those? 200 pop. Okay, cool. Yeah. And what was after that?
Huntfield Heights, also in Adelaide.
Yep. No.
No, hang on.
No, Mount Warren Park.
No.
Goulburn.
No.
Goulburn.
Goulburn. Yeah.
I forgot the order we went in.
Yeah, it's hard sometimes, isn't it?
Yeah.
What did you pay for that in Goulburn?
240.
Okay, cool. And then what was after Goulburn? So Goulburn sort of in between Sydney and Canberra.
Yep.
Yeah.
Then we went to Huntfield Heights again in South Australia.
Okay. And what did you pay?
213.
Yeah, cool.
In Mount Warren Park?
No,
that was later. Oh my God.
Wodonga? Albury Wodonga, yeah.
Yeah.
Got 2 there.
2 there.
And what, Albury Wodonga? Okay.
Yeah, because I figure by the time I do all my research, I may as well
get 2.
Yeah. Okay.
It was Jeanette did all the research.
I did all the shopping.
Jeanette did all the buying.
And he finances
it. We'll talk about that dynamic in a sec. Okay, so where else have you got some places?
College Street in Cambridge Park.
Okay.
Yeah, and then we ended up putting a granny flat on that. We bought that with the view of...
Yeah, got a granny flat put on that.
How much did you pay in Cambridge Park? Which Cambridge Park near Penrith?
Yep.
346.
Okay. When did you buy that?
Just
2013, October.
Okay, I reckon you've done pretty well out of that.
Yeah.
Yeah, we got a place in Cambridge Park.
And then we've
done really well.
Put a granny flat on that cost about 130 thereabouts.
Okay, what's your combined income on that a month now with the granny flat and the house?
Granny flat almost pays as much as
the yield.
House.
Probably yield pretty well.
We get about 700 a week.
Okay, that's pretty good. It's good yield. Cool. All right, after Cambridge Park.
Then we went to Queensland, yes. Yeah. Mount Warren Park.
Yeah.
And Bray Park.
On the northern side, and Maria Field.
And Maria Field.
Yep.
That was all in 2015, 2014, 2015.
And then I wanted something in Melbourne, so then we went down for my godson's 21st, and I said to Max, because Melbourne's I find harder to buy in because of auctions and everything else. So we went down and I said to Max, we're buying a property this weekend, and we got one in Mill Park. So cool. People had just literally put it up, and they were going into a nursing home, weren't they? So we walked in and said,
it wasn't really on the market. We just happened to go and look for things, and the agent said, I got one in Mill Park that might suit you. Let's go and have a look at it. So we did.
And that goes to show that you're probably financially ready to go and confident to buy again, and that's another...
That one we broke all the rules. We went...
That
one we broke all the rules. We went unconditional and utilised that 3-day cooling off period.
To do what you need to do. Yeah,
so
that's
we could
cool.
sign, seal and deliver on that one. And then the last property we bought in our super fund was at Eden's Landing.
Okay.
That's also in
Queensland. So
cool. So if you sort of look at the total value of your portfolio now, what would it be? What would be valued at?
I'll tell you that
on the spreadsheet.
On the spreadsheet, 5.2.
5.2 million. And what sort of debt are you holding now on that property?
3.9.
3.9. Okay. And you want to retire in 5 to 7 years?
Yeah.
So how are you paying the debt off? What's the plan? I sound like I'm doing a...
No.
So the idea is that, and if you showed me, no doubt, the information that Ben put together, you would have a curve that shows you paying the debt down and income and stuff. So what you've determined is that you can keep the entire portfolio if you want, which means you need to pay down a debt as quickly as possible. So you got 7 years to sort.
So we've got the offset account.
We have set up offset accounts. Okay. All the money goes into there because again, you need to have money when you're in the period that you don't have your super access. And that will be the offset account, and that depletes, and then you go over to the super fund. And
so there'll be a point in time where you're completely unencumbered.
I doubt the whole will be completely unencumbered.
So there'll always be a little bit of debt on it. Yeah. And what will you sort of work that down to, do you think? You just don't know?
I don't know yet. I think we'll get rid of it by selling some and
just go that way.
I think in the end it will be, as I said, the kids are not going to be the beneficiaries of all the...
Do they know that? Have you told them?
Yeah. Look, they'll get something, I'm sure, but we're not building this up to create a big, huge family empire or anything. It's just...
They can build their own. I had to build my own. They can build their own.
There's something to be said about it. And I think about this sometimes about, you don't want to give too much because you need to create the desire and the need and the drive to create something for yourself, to get a big portfolio and just go, thanks for that. I think you appreciate the hard work that goes into it, right? So it's a bit of a catch-22, but at least you've got options though. You've got a portfolio and then you still got a number of cycles you can hold this through into your retirement. So you'll think that continues to go up in value, which is good, and rent should follow. And
we hope so.
So do you intend to sort of pack up and go cruising,
I've got my little caravan.
Sort of stuff? You got a caravan?
I want to go caravanning.
Yeah.
She bought the caravan.
I want to be able to turn right and keep going.
Yeah, cool.
I'd like to be able to do that and just see where life takes us and travel. And
will you miss work? Do you like work?
He will.
I like work.
Yeah.
But I can also work and not work. I can...
We're in the RFS, so, I'll just send him off to the fire station more often. And
get going, do more volunteer stuff.
Or the men's shed or something. I work in aged care, so I know how to keep the men busy.
Aged care's it's a huge industry now,
Tell me about it.
Yeah.
It's so many issues and problems in that area.
Yeah, it's a real challenge. Yeah, it's a booming industry. There's a lot of people making good money out of property in aged care, but I don't know whether it's always the right way. But anyway, I'm not going to go into that at the moment. I've got a bugbear about it.
But podcast on something totally different.
Absolutely. So how do you go? So it's quite a diverse portfolio. How do you go about managing it? Do you use agents and stuff?
Property managers.
Property managers for all of them.
Yeah. And how do you find that? Are they all? Do you sort of got some common ones? Or are they all separate?
Yeah. We got Wodonga, because we've got two there. We've got the same. Morayfield and Bray Park is the same. Elizabeth is the same. To the same, because they're all in the same area.
And they're normally all pretty good. I mean, when I selected them, because when we did the course with Destiny, you learn how to pick a good property manager as well. So I grilled them and found out, what they were good at, and put them on that. So most of them have been pretty good. So
I think most of them we stayed with, so they've been good.
We expect inspections done, and sometimes they'll say, do you want to increase the rent, and if so, by how much? I'm like, well, this is what I'm paying you. What's the market doing out there? I will do my own research as well, but push them, and so now they sort of know that they have to come to me and say, well, market's a bit flat, so we wouldn't put the rent up, or we can go for $5. I think Goulburn's just gone up, hasn't it?
Yeah,
it's going up $10.
Yeah.
So, you know,
But they need to come to us and say, hey, you know, we think...
Yeah, you got to ride them sometimes pretty hard. But So run me through the process of this team. So I'm
the shopper.
You're the shopper and you're the manager, essentially. So
Financier,
portfolio manager. So how much time would you spend a day, a week, a month talking about property? Is that something which is a big driver of your conversation?
You start researching, and like I sort of zoned in, like with Elizabeth East, for example, you know, a week or two, and because we had the backing of Destiny where I could float a few things off to them, shoot them off and get some opinions or whatever. But once I decided on an area, once that was done, I was sort of like, bang, throwing offers in. And
there you go. If you're going to crystallise what you learned from Margaret's course, and we know Margaret quite well at Smart Property Investment Show, she's very good at what she does. What would be those three things to identify the right market to invest in?
Oh, you've got to have a younger family, you know, so there's going to be education and hospitals, all the economic factors coming in to the areas.
What do you use?
Diversity, you know, the infrastructure, you know, whether it's a bit of government, private, everything, you know, and growing population.
Not have too many,
perhaps a lower
other you know,
things happening
that are happening in the area, not just mining or something, or you know, multiple
different economic
probably
stuff.
Lower socioeconomic areas that are surrounded by slightly better areas, so that hopefully it'll
fill in. Gentrify.
Gentrify, that's the word. Because most of the places we've bought are probably more traditional working class, I guess you'd say. A lot of them, not all of them, but potential for future growth. You know, it's...
What is about the buying process that you like the most? Is it,
I don't know if I like it. I think just this knowing that we were going to be doing something positive towards our retirement.
So it's not the process, it's the actual benefit of
the benefit, knowing that we could. It does give you a bit of a buzz, you know, when you get something accepted and, you know, you sort of...
Yeah, then she comes to me, okay, better go and get some money now.
Do you think you've bought well? Is there anything outside of, you said your castle probably took a little while to kick it again?
Yeah, I think we've bought reasonably well. I mean, I know South Australia, the ones to an Elizabeth East.
They don't move so quick.
But
they pay reasonably good rent for what you paid for them.
Yeah.
You know, with hindsight, you could always look back and think, oh, look, I perhaps could have bought something a little bit better or different in an area. I'm happy with the areas that we've bought in. They're all for different reasons. Initially, you know, we didn't want to spend too much because we're sort of like, you know. So
I think in the beginning we sort of said also, you know, if we buy 3 instead of 1, you got 3 incomes. You got, if one goes empty, you still got 2 incomes. If you have 1 and it goes empty, you got nothing.
And this is a layer of diversification. A lot of people think diversification is type of properties or where you buy them, but sometimes it's the number of properties as well. You know, the risks it a little bit. It's only if one whole area just collapses and the lower end property market sort of falls a bit wet, it's probably not going to do that. So it's so you enjoy it. You know, this is
we have enjoyed it. You know, every now and then. Sometimes
she can't shop anymore, so now she's
can't get money anymore.
So that's it. You're not buying anything more. Done.
I think we can't get money.
Yeah.
It's really hard.
It's getting hard.
Yeah.
And now that we've done our modelling, we know we will be able to retire comfortably. So, but we've got friends that we met through our journey that, you know, we still hook up the club once every couple of months and talk.
See what's going on.
Yeah, and just join PICA, the Property Investors Council of Australia, because I think that's a positive, something that all property investors can get involved with, because, you know, last year when we bought Eden's Landing, we signed the papers the day after the budget.
Oh,
so,
did you?
Yeah.
Okay.
It's like, but, you know, how can, you know, we need a voice to be able to push the government saying, you know, why are we copping all the burden of having...
Well, you know, we us property investors, we definitely serve a purpose for providing housing for many, many Australians, and I think it gets overlooked sometimes, and it gets clouded by you know, taxation issues, and
it's just,
you know,
we're an easy target.
You're called wealthy. You're not wealthy. You just carry a lot of debt. You know,
we do.
So, have you about buying all these properties? Have you refinanced along the way, or have you do you save up a chunk of cash, buy another one?
Well, because we had paid off our own home, it was actually quite easy for us to, at that time, to just start, okay, we get a big loan on that, and then take the deposits out of there.
Okay.
and then finance everything on each individual house.
Mm.
And yes, we have refinanced at some stage because we wanted to fix some at the time. But most of them, we're still with the same lenders. Just going through one of them at the moment, Mill Park, that is running out of its fixed term.
Okay.
So they want to start talking about, and most of them are interest only.
Yeah.
They want to get rid of that, of course.
Well, it's one way you can start paying the debt is just go principal and interest on everything.
That's right, and they've offered a reasonable. 4.59%, I think.
It's not bad.
For fixed for 5 years, so that's okay.
Yeah,
that's reasonable.
Yeah. So
I've picked several now.
Yeah.
Just
do you use a mortgage broker?
We've got several actually.
Okay. Does it make sense to have several mortgage brokers? Do you think it's better just having one?
We just went from one to another to another, and some of the loans are still with one.
Okay.
And I don't know. I've listened to yours and I think, maybe we should talk to somebody else. And but at the moment, because we're now in a consolidation phase, really. So we're not really looking to go and
it's about making sure that you've got the best performing interest rates possible and the best products to make sure you can key priority for you guys driving down debt.
We were looking at changing the loans, weren't we? But But because of the rules and that now, we don't meet the criteria because, with serviceability and everything. So we're sort of locked in with what we've got and, we'll the banks.
Even Macquarie said straight away, if you want to change it, we can still talk about interest only and all that sort of stuff. But then we have to do a real full assessment again. So you go through the whole...
Sometimes it's best not to go through those, that headache and heartache.
Yeah.
So, do you think you guys have done a good job? Is there anything that if you had time again, you'd do? Other than maybe start earlier?
Probably start earlier, like everybody else says. And
definitely.
maybe not buy the Castle Hill one when we did.
Have the confidence and realise there's education out there and source the good education. We should have done it because we actually looked at doing Destiny.
A long time ago.
When our son was 3 or 4, but Max was travelling and, we sort of couldn't juggle it and we didn't have any family in Sydney. So it was sort of like,
forget about it.
Yeah.
It was a big lump sum of money at the time, and it was sort of like, no, we'll put that off. And
it's what stops most investors initially is just procrastination. There's always excuses not to do something. I can find 1,000 excuses not to do something. It's just about understanding what's important and where you want to go. And I think you've realised that you've had a good 15 years in the market now, and some assets there. Which what's the best buy you've done? What are you most happy with?
I think
in terms of a capital growth play.
Actually, Cambridge Park probably because we had the opportunity to put the granny flat on, and that's a good one. Mill Park is probably.
I think Mill Park will be good. It's already gone up. The house next door sold.
Goldman's actually not bad.
Yeah, Goldman's done well. It's sort of it doesn't get a lot of noise around it, but it has been a reasonable performer over a length of time. And they're talking about sticking this train line in, aren't they, all the way from?
They're always talking about trains.
Last 20 years.
I know people who are actually buying some property along that rail line just in case,
Just in case.
That's cool. Yeah. Sounds like you enjoy it. Who's the dominant force in a relationship around property? Or do you think is it a genuine partnerships?
She's the dominant one. I just
haven't got money.
Make sure that all the figures are right. And
he would say how much he thought we could get, and so that also dictated, I guess, the area that we would look at, and then. So,
and I just make sure that all the bills go in, and I do, I hear you talk to Steve, right, and they say, you got to spend time on that, and I do. I make sure everything is in there. I know exactly what's happening.
And it's probably unwise for me to ask this question, but I'm going to do it because that's the way I operate. Has there been a point where it's actually been in this partnership outside of the life you've built, but this property partnership, that there's been a fundamental, we're completely opposing sides of this, and I'm right and you're wrong. Has that happened?
No, the only thing that she might not have liked at the time was the granny flat. Yeah. Because I said, well, there you go, you can go and build the granny flat.
I didn't enjoy that process.
So there's never like a veto that says, it's just not going to happen? You always work your way through it?
Yeah. For a long time I avoided Queensland simply because I just felt, I don't know, the weather and...
Too many cyclones.
Too many
floods.
Where a lot of other friends were buying stuff.
So a lot of people bought flood-affected stuff and just got hammered, and that changed the market quite a lot up there.
So
what was that, 2012 maybe, was a big floods went through there? There's been a couple of them.
Yeah.
Well, that was tarnished. We started it those days, so we said, we'll stay away from that flood.
So anything that had been renovated in Queensland was like, has that been flooded? Is that why it's been renovated?
You're moving into this sort of consolidation phase and pay down phase. What would be your tips for them to make sure they get it right?
For consolidation, or for the starting off?
Consolidation. What do you need to know? Just get in the market earlier, I think, so you got a longer period for your properties to
and know
brew.
where your money is going when you're spending, because as much as I, like being miscellaneous, it is good to know where my money is. Have a good budget. Or
sometimes, I don't budget that well, but I sometimes look at
budgeting as such, but just being aware of where your money is going.
Money just goes. You're not watching where it goes.
Yeah.
Like, I don't think I spend much money, but I still manage to spend a lot of money.
Yeah.
That's
I
right.
have no idea where.
And the problem is if you don't keep in track of it, it's sort of, you get more money, wage increases, whatever. It just goes.
Yeah.
It just
that's what they say. As your salary increases, you just consume the gap, and you just end up saving no money.
Yeah. I would like to get the kids to do this.
Yeah.
I would like them to do the investing. I don't care where they invest.
Would you help them out? Would you give them a little head start with a?
If they found something.
Max would lend them some money.
Yeah.
At a reasonable interest rate.
At a reasonable interest rate.
He's Dutch, remember.
Some of the clauses, the conditions I see people draw contracts between parents and their children. It's quite entertaining, but I think it's more of you just want to make sure they actually understand the responsibility they're taking on. Most parents want to give their kids a head start. I'm not there yet. I've got a few more years got to worry about that sort of stuff. But anyway. There we go. Guys, really enjoyed the chat. Thanks for being so honest and frank on this journey, and some really good points there. I think that everyone can listening can learn from it. In particular, the benefits of starting sooner rather than later. The longer you're in a market, the better you can do, as long as you're buying the right properties. But also making sure that you have an end goal in mind, and that is, you can't retire on a property which you don't have any equity in, so you've got to pay the debt down at some point. So. But I think the process you've gone through in education with Margaret's stuff, and that's great. That's a great education in what you should be doing, and I think also the work you've done with Ben on just understanding where you're spending your money and what this end goal. And
it was actually Steve that put us onto him.
Oh, was it?
Yeah, because he said, have you actually planned what you want to do? And I said, well, not really.
That's an important point.
Yeah.
So keep at it. Let's stay in touch. Keep tuning in, Max. I hope you enjoy it, and let's get you guys back on in maybe a year's time and see where you're at, and have a look at, hopefully your portfolio's gone up in value and paid the debt down. That's the goal.
That's the goal.
Appreciate your time. Thank you.
Thank you.
Right, thank you.
Plenty more stories like Jeanette and Max on the Smart Property Investment podcast, which you can find on smartpropertyinvestment.com.au. You can also subscribe to make sure that you're getting all the latest ones that are coming out. smartpropertyinvestment.com.au/subscribe. Also plenty on social media. Just search for Smart Property HQ. You can like us, follow us, and you'll make sure you're getting everything we know. So you're the first to know what's going on in property investment. Please keep those reviews coming on iTunes as well. We do appreciate them. The team here in particular really get a lot of satisfaction out of seeing these comments. So 5 stars if you're happy. Anyway, we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.